and Dutch government had to compensate their citizens. And this is obviously a serious problem. So there are a number of difficulties we can see because of the international dimension of financial services. I wish to return to this as the problems of the relationship between the regulatory systems in different countries is a critical one if we wish to avoid the danger of what is called regulatory arbitrage, where banks choosing to move their operations to avoid the constraints of their home jurisdiction. In discussing the methods of ensuring the long-term stability of the financial system, the two broad approaches are to develop and make more effective the existing regulatory system, or to examine the more radical structural changes. And the Pittsburgh Summit communique of last September's G20 meeting set out proposals both for more effective regulation, when they said we are committed to act together to raise capital standards, to implement strong international compensation standards aimed at ending practices that lead to excessive risk-taking, to improve the over-the-counter derivatives market, and to create powerful tools to hold large global firms to account for the risks that they take. But we also need to reform the global architecture to meet the needs of the 21st century. And indeed, one of the important things that has occurred in the period last year was the setting up of the G20 to be the premier forum for international economic cooperation, and the Financial Stability Board, which included the major emerging economies, and therefore is able to coordinate and monitor progress in strengthening financial regulation. Not enough attention has been given, I think, to the achievements of the international community in responding to the crisis by creating those institutions. The G20 expanding from the rather restrictive G7 of a limited number of Western countries to involving the major emerging economies of Asia, Africa, and Latin America, moving towards a global approach to a global problem. The results of this will be seen in the coming months, as the end of 2010 has been set in the Pittsburgh communique for many of the objectives of improved regulation to be achieved. The crisis showed all too clearly the weaknesses of the existing structures of regulation of the financial system. Financial engineering left banks holding far too little capital. Liquidity requirements will also need to be tightened, and leverage, the ratio of debt to capital, more carefully constrained. The proposals are now being put forward, and in fact the Basel Committee, which is preparing these, which is a body made up of the central bank governors and the heads of the authorities responsible for supervision of the banking system in 27 countries, have produced a consultation document which is proposed setting up a global minimum liquidity standard and higher capital reserves. A further important proposal is to introduce a series of measures to promote the build-up of capital buffers in good times that can be drawn upon in a period of stress, and therefore some form of counter-cyclical capital framework will contribute to a more stable banking system. It will help to dampen instead of amplifying economic and financial shocks. Spain has had a system of this sort in existence, and it has received much favourable attention since the crisis. There have also the finance ministers of the European Union also agreed in July of last year that something of this sort should be agreed at a European level. And all of these proposals are at work in a work in progress document, work in progress, as the consultation document made clear that banks and others who wish to comment on them can do so until Friday of this week, Friday the 16th of April. It's perhaps worth noting that there was an article in yesterday's Financial Times, and yesterday's Financial Times contained an article setting out how, and I quote, investment bankers have begun to develop ways in which banks might be able to circumvent the most punitive of the new capital rules being drawn up by international regulators. So drawing up rules by themselves is perhaps not enough. The Governor of the Bank of England recently explained these changes, saying, "The banking sector is running with a much smaller amount of capital and a tiny amount of liquid assets in comparison with the banking system of 40 years ago. And this inherently makes it more unstable, so more capital makes more sense. And I quote to continue, "It's not an answer in itself, because the only logical capital requirement that removes all risk is 100%. As we shall see, Mervyn King, like Paul Volcker, believes that structural measures are also necessary. He has warned that, and I quote, "tinkering with capital requirements may not be enough, and that structural changes will be important. One of the reasons," he went on, "why capital alone will not work is because banks can just take more risks to offset a higher capital requirement, getting you right back where you were before." While there is now general agreement that more capital should be held, there is also some concern about how much more and when the requirements should come into effect. This is quite important, for higher capital requirements will increase the cost of borrowing, and at a time when one is anxious to increase the lending activities of banks, it's probably not wise to move too quickly on increasing capital requirements. There are, linked to the question of increasing capital requirements, the idea as whether there couldn't be further costs put on the banks in the form of specific tax or levies. President Obama, in January of this year, proposed a financial crisis responsibility fee. This fee is designed to last for 10 years and will cover the costs that the United States has spent on the TARP and in other programs. This is an ex post levy. As an alternative, 3 European countries, Britain, France and Germany, have suggested there should be a global system of levies paid in advance. This would be some form of insurance policy to cover the costs of future bank rescues. This is being considered by the International Monetary Fund, and they are likely to bring some proposals forward which may look at both of these approaches for their spring meetings in Washington next week. And it's likely that this will be taken forward by the G20, if not in their meeting in Toronto, at the meeting they're going to have in November in Seoul, in Korea. But I think we have to remember that while a levy of this sort will cover the costs which the governments may have incurred directly in terms of bailing out the banks, it will go nowhere at all to compensate the national economies for the costs of the global contraction that has followed the banking crisis. A recent estimate for this from the Bank of England produces a figure of costs of the downturn in the economies across the world that have occurred in the last 15 months. The figure that they estimate the cost of this by the time we have completed it and returned to a norm between $60 and $200 trillion. A levy to cover this is unimaginable. It is because of this that there has been a lively debate on both sides of the Atlantic as to whether there should be structural changes to deal with the risks created by large and systemically important institutions. And the Financial Security Board's Standing Committee for Supervisory and Regulatory Cooperation is tasked to produce a report on this for the meeting of the G20 in Seoul in November. This problem is linked to the problem of so-called moral hazard, the encouragement which is given to banks and financial institutions to take excessive gambles if they believe that in the end they're going to be bailed out by the state. This is the problem of those institutions who, either because of their size or interconnectedness, would of course put the whole of the banking system at risk if they were to fail. It's particularly difficult to provide a general rule about this across countries because banking structures and cultures vary widely, and even within a relatively homogeneous area, such as the European Union. In the UK, as we'll see, the Governor of the Bank of England and some, but not all, of the academic community have advocated looking at a rather radical position, but others, including Adair Turner, the Chairman of the Financial Services Association, the principal regulator, has adopted a position not very dissimilar from that put forward by President Obama and Paul Volcker in their press conference of January the 19th. The government and the banks, on the whole, have been a good deal more cautious. The large banks have argued that there are a number of significant advantages in having large banks, global banks, which bring benefits to the financial and economic situation, the system. That large banks bring financial efficiency, they have greater risk diversification, they have advantages to their customers because their customers are able to have access to a range of needs. There are advantages to international trade, there are advantages to competition and innovation. And of course, in London they would say there are benefits to the UK because of the importance of having so many UK domiciled banks operating internationally. The contrary position can be found in the position which has been put forward by the Governor of the Bank of England, and I just would like to quote him on this. I do think that I would like to see an outcome in which the size and variety of activities contained within these big institutions, if they're going to be financed in the way they are, is a lot less. To have a small number of big institutions dominating world banking is not a healthy position to be. And his colleague Andrew Haldane, who has written widely on this, spelt it out. The economics of banking do not suggest that bigger need be better. Indeed, if large-scale processing of loan risks leads to economising on the collection of information, there might even be diseconomies of scale in banking. The present crisis, in his words, provides a case study. The desire to make loans a tradable commodity led to a loss of information as transactions replaced relationships and quantity trumped quality. Within the space of a decade, and I quote, banks went from monogamy to speed dating. Evidence from a range of countries paint a revealing picture. There's not a scrap of evidence of economies of scale or scope in banking, of bigger or broader being better, beyond a low size threshold. At least during this crisis, big banks have, if anything, been found to be less stable than their smaller counterparts, requiring on average larger scale support. It can be argued that big business needs big banks to supply their needs. But this is not an argument that big businesses themselves endorse, at least according to a recent survey of the Association of Corporate Treasurers. A particular problem arises in Europe as the European Union single market is based on the principle of mutual recognition. All financial firms established in any one country of the European Union can open branches in another member states. And one example of that, to which I've already referred, is the problems which occurred with the Icelandic banks. Iceland is not a member of the European Union. It belongs to the single market as far as financial institutions are concerned by virtue of its participation in the European Economic Area. And it caused, as we have seen, a great deal of difficulty. There are many who therefore feel this experience shows that host countries should have more opportunities to regulate banks from other EU branches, in effect turning them into subsidiaries which would be controlled where they operate rather than as branches. This, however, might require EU treaty revision, which is not terribly popular after recent experience. The creation of subsidiaries as a way of segmenting global banks geographically. The other proposal to segment banks by their type of business is the idea of creating what is called narrow banks, and it's the most radical form of structural reform, being put forward most directly in the UK by Professor John Kay of the LSE, and can be explained to an American audience most briefly by saying it's a 21st century version of the Glass-Steagall legislation, and can be seen in the position in the United States of some people like Professor Koltikoff of Bolton University, and in a modified way in the writings of Professor Simon Johnson of MIT, a former chief economist of the IMF. Narrow banking implies the creation of a banking institution focused on the traditional functions that the financial system offers to the non-financial economy. A payment system for institutions of all sizes, deposit taking from individuals and small and medium-sized enterprises, and only narrow banks specialising in these activities could describe themselves as banks. Only narrow banks could take, in John Kay's model, deposits from the general public. Only narrow banks would qualify for deposit protection. The rest of the financial system would be unregulated on the basis that its failure would not undermine the basic banking function which are required for normal personal and commercial transactions. Professor Kay also proposes that the liabilities of the narrow banks should be matched by safe assets. Almost certainly these would be government securities, but there could perhaps be some others. While there is a very good theoretical case for this approach, and it does have some resonance in both the United States and the United Kingdom, where the historic experience of the distinction which existed in the United States under Glass-Steagall, or in the United Kingdom in the distinction between merchant banks and joint stock banks, it is easier said than done. This is partly because in other advanced financial systems, for example Germany, France, Switzerland, the concept of universal banks is widespread, and the concept of the major restructuring which would be required to move to something along these lines would certainly be difficult. In addition, there is what is described as the boundary problem. How would one really be able to keep the two parts of the financial system strictly apart? Our experience is that the ingenuity of those involved, together with the possibility of variation of regulatory systems in different countries, would mean that we would not necessarily avoid financial crises, which have very different, very serious effects. There has, of course, been some sympathy among central bankers and senior regulators in London with the proposals that were put forward in January, on January 21st, by President Obama in the President of Paul Volcker, and referred to by the President as the Volcker Rule. And that was banks will no longer be allowed to own, invest or sponsor hedge funds, private equity funds or proprietary trading operations for their own profit, unrelated to serving their customers. The economists described this as Glass-Steagall light. Proprietary trading is therefore trading on behalf of the firm rather than on behalf of the clients or the customers of the bank. And while both the Deputy Governor of the Bank of England and Adair Turner, the chairman of the chief regulator in Britain, felt that in principle this was the right direction of travel, they felt that in practice it would be difficult to define proprietary trading, that the objective might best be implemented by higher capital charges on activities that regulators deem risky rather than an outright ban. And this is perhaps rather closer to some of the positions which Paul Krugman has put forward. In any case, there is considerable interest in the UK as to how the United States will be able to legislate on the Volcker plan, or Volcker Rule, and define proprietary trading. It's distinct from the central bankers and regulators. The British government, in its statements, has rejected limits on bank size and complexity. And in this they have been supported in Britain by the Conservative opposition, so there would not be a change, even if there was a change after the election. The government, I quote, find little evidence to suggest that artificial restrictions on a financial institution's size or complexity, including a distinction between commercial and investment banking activity, would automatically reduce the likelihood of failure. While the government has turned it down, the debate continues. And, for example, Andy Haldane of the Bank of England, in a speech which he made at the end of March, said, "We're at the start of a great debate on the future structure of finance, not the end. Some fear that the momentum for radical financial reform will be lost. But financial crises leave a scar. This time, sovereign scar should act as a lasting reminder of the criticality of reform. Today's crisis has stretched some states' sinews to the limit. both literally and metaphorically, global finance cannot afford another. Similarly, in a report on the subject published on March the 21st of this year, with unanimous cross-party support, the Treasury Committee of the House of Commons concluded structural reforms should not be ruled out. The progress of Senator Dodd's committee in working out these issues and achieving legislation will therefore be watched with very great attention in Westminster as well as in the City of London, and no doubt in Wall Street as well. The third element of financial reform which I want to speak just briefly about, which is considered in London as well as elsewhere, is to have better planning for the worst case outcomes so that governments are not faced with the dilemmas of being forced to choose between saving institutions, bailing them out, or risking financial stability. That again, of course, is touching on this issue of moral hazard to which I have referred. If institutions feel they will not be allowed to fail, this leads to greater risk-taking and therefore reduces market discipline. It's therefore felt essential that there should be arrangements which would ensure that even if the largest banks were to get into difficulties, they could be resolved, that is, wound down and liquidated in a way that did not put at risk the rest of the financial system. The UK has been working on developing such a resolution authority, and the United States, of course, has comparable arrangements used by the FDIC to deal with the failure of smaller banks. What we now need to think of is how is one able to do it with the very large institutions. In this respect, the concept has been developed that banks should have something which is referred to as living wills. Big banks should be required to develop detailed pre-packaged resolution procedures that would be applied when regulators judged that the bank had gone beyond the stage where prompt corrective action could save it. Particular problems, of course, arise with international banks, where cross-border problems arise. It is the case that in different countries, the laws on bankruptcies are different, and therefore to get an overall model is difficult. This already occurred in the collapse of Lehman's, where an organisation which, as has been said, was international in life, became very distinctly national in death. There has been some progress in this, and there's been a memorandum of understanding, I understand, agreed between the Bank of England and the FDIC, and going beyond this, it's very interesting that the chairman of the Financial Stability Board's working group has said in October of last year, basically for the top roughly 25 bankers and dealers, the authorities will work with them over the next 6 to 9 months to produce recovery and resolution plans. This will build upon the existing arrangements, and that, of course, is at a cross-border basis if required. This will produce two things. First, recovery plans for reducing the risk of a group where it can and should be maintained as a going concern. Secondly, a resolution plan when a firm needs to be wound down and put to rest, but with the essential economic functions maintained somehow. I've quoted at length because if this challenging task can be achieved, I feel it will be of great importance in increasing international financial security. I think I should perhaps just add that the chairman of that group went on. No one should think that this will be easy, or that anyone in the official sector is naive about that. It will, in fact, be formidably difficult. The process is, for that very reason, designed to flesh out the issues so that they can be properly debated and reviewed. What is encouraging, however, is that at an international level it is being attempted. We should look forward to the day when we can be told that it's been achieved for all of the systemically important institutions. It can be argued that the process of establishing resolution schemes or living wills will have the additional benefit of obliging the banks to unwind some of the more complex features of their organisational structures, and that living wills, if fully applied, will lead to a partial structural reform of the banks. While at global level it's probably unrealistic to think of an international authority able to take the lead, which would make it easier, There have been attempts to do this at a European level. The European Commission has been examining what they refer to, and I'll just come back to this phrase in a moment or two, a European crisis management system which would extend to resolution and liquidation of cross-border financial entities. Such an approach, including the creation of a European Resolution Authority, has recently been backed by Dominique Strauss-Kahn, the Managing Director of the IMF. On the other hand, I'm sorry to say that the British authorities, the Treasury, the Central Bank and the regulator have on this occasion been united and poured cold water on the proposal, arguing the problems arising from different insolvency regimes across Europe means that the ultimate financial responsibility should remain national. This one will certainly take some time to introduce. I realise that in a lecture on this subject I should also have treated the questions of sovereign debt, which are now becoming central. But that would have meant that the lecture would almost certainly have been a running commentary on the extraordinary developments and relationships between the Greece and the euro, a subject on which, of course, I'll be happy to comment on discussion. When I arrived in Bloomington last week, I discovered that the flyout for tonight intended that, apart from addressing international financial security, which I've been doing, I was also going to answer the question,